Good morning. Just wanted to introduce my team. Thanks for spending the next 30 minutes with us. We're doing something a little unconventional today. We are going to actually share some slides. We don't like to do slides. We prefer our fireside chats, but we have a little bit of material we want to present to you. It is a little more data science oriented, as you can see. We're going to get into some models, and then when my colleague Don joins, we'll be kind of bantering back and forth, probably in the section that I cover. So if you've got any questions, make sure you throw them into the chat. And if you're interested in the slides, we can also forward those along as well. They're pretty interesting. So with that, I want to introduce my colleague, Daniel Julius. Daniel has been working with MetalMiner for a while now and working on our product development team. Daniel's really been at the heart of a lot of our data science capability. He's worked on our correlation capability, which we've had for several years, but he's coded a lot of those models into our system. He's also developed our forecast manager capability, which allows us to better see the relationships across metals. And so I'm going to dive deeply a little bit later on into some of the unique correlations and in some cases myths that people have or hold about the relationship between metals and share with you how they change over time. But with that, I'm going to introduce Daniel and have you take it away from here, Daniel.
Thanks, Lisa. So if we can move on to the next slide, I'll just talk a little bit about what this webinar, the overarching theme of the webinar. So, we're in a bear market. Prices are going down. We understand that procurement managers have tried the basics. Hopefully you've gotten some cost savings out of that. But today we're going to present a couple bit of some unconventional ways that you can save money. So let's get into it. So I'm going to cover 3 specific recommendations that we have that kind of use data science-y principles to help you squeeze out a couple extra pennies of cost savings. Starting with a simple one, and I wouldn't be surprised if some of you are already using this, is using data visualization techniques. So visualizing your spend data will help you see it from another perspective and spot those savings that you were previously overlooking. Some of our favorite ones include spend cube analysis, spend trend, and spend by supplier, which I will show you on the next slide. So a spend cube will help you identify your biggest raw material costs, and then you can focus on reducing those. So those blue boxes over to the left are where you're going to want to focus your energy on a spend cube analysis, not those little smaller boxes over to the lower right-hand corner. So it's a good way of visualizing how much you spend on what material and where you can direct your energy. Same with spend by supplier in the lower middle. Focus on which suppliers are costing you the most money and, direct your energy there. Then spend trend directly above spend by supplier is a really neat way to take a look at your cumulative spend on all of your material. So in a bear market, that trend line should definitely be heading downwards. But how do you know if your total spend is decreasing as much as it should? And for example, if your total spend has declined 5% over the past 6 months, how do you know that others haven't achieved a cost saving of 6% or 7% or more? And well, that's where correlations comes in. And this is kind of a nice introduction to what I'm going to talk about next, actually. But if we could go back to I'll wrap this up in just a second. But what you can do is you can correlate your spend data to a specific commodity or an index. And at MetalMiner, we're actually really excited because we've launched an index tool where you can develop an index that will mirror your spend. And that can help you, so if the index is going down faster than your spend trend, then you need to work on more cost savings. So that is kind of a benchmarking tool that can be used to gauge your spend. Okay, now moving on to recommendation number 2, map to your demand. So having access to third-party data, like the stuff in our database, but really you can correlate to anything, lets you correlate to your own internal data, including demand data, to gauge the strength of your demand. And once you find the commodities that correlate well with your demand, these will oftentimes be a leading economic indicator of where your demand is heading. So with an additional tool to forecast demand at your disposal, you can get a better sense of your demand. Okay, and on the next slide, I'm going to highlight what might be obvious to some, but is still worth mentioning. In a falling demand market, you will want to buy as needed, because on average, the price tomorrow will be lower than the price today. So if you buy at that first orange point to the left of the chart versus at that second orange point, a little bit further to the right, you're going to get a better price. Even today, you can see that aluminum price is breaching our support, which means that we expect prices to go down. And that means that if you buy tomorrow, you'll get a better price than if you buy today. So my point in saying this is that if you can run a tighter operation where you can forecast demand better, you can generally achieve some cost savings there. Okay. And last but not least, study your purchases. So a universal rule is that a better understanding of the commodities you buy will oftentimes translate directly to cost savings. Okay, and moving on, let's say you're a buyer of grain-oriented electrical steel, but this will work for any commodity that you buy. So to use correlation analysis to better understand your commodity that you're purchasing, you're going to want to do these 3 things. So first, hypothesize what you think will correlate. So if you think copper might correlate with GOES, add that to the list. US dollar, lithium, aluminum, add everything to the list of potential predictors that you think might correlate. Number 2, put it to the test. Use our correlation tool, but again, you can use any form of correlation tool that you prefer to see which of those predictors actually have a statistically significant correlation. And then finally, generate some inferences about the future. Commodities that historically correlate obviously mean they tend to behave similarly, which means you may have found a leading indicator. So now I'm going to walk you through the correlation tool. Okay, so step 1 is going to be to select your prices. So in this case, you would select GOES and all the predictors you think might correlate with GOES. Okay, moving on. Okay, let's take a quick break for audience engagement here. Make sure nobody's falling asleep. And type your guess in the chat what you think grain-oriented electrical steel might correlate with between the US dollar index, copper, and lithium.
So go ahead in the chat feature and just throw in your answer, your guess.
Take just a minute, and then we will see what correlates on the next slide.
Ready?
Yep. Okay, so here is the output. And in that GOES column to the left, or to the right of the screen, I apologize, you can see that GOES has about a 90% correlation with lithium, less so with the other 2 commodities, and of course 100% correlation with itself. So the answer would be that in this case, GOES correlates with lithium. So those who said lithium in the chat, you were right. But now what do we make of this? So finally, on the next slide, I'm going to show you, kind of the meaning behind this. So here we have a chart of lithium hydroxide as well as GOES, and you can kind of see how there's a visual correlation that happens between these 2 graphs. You can see that prices are kind of declining at about the same rate. Then around maybe late 2020, the prices hit a bottom at the same time, then both go up, up, up. And you can see that lithium has been in a downtrend since the beginning of this year. GOES has not. But if we know that they correlate, perhaps we could say that lithium is a leading indicator for GOES. You'll also see our GOES forecast shows that prices are expected to decline. So we have our AI forecast saying that prices will decline as well. So this is kind of a neat way that you can see how one commodity could be a leading indicator for another commodity.
Great, Daniel, I'll pick it up from here. Again, if any of you have any specific questions about AI or correlation analysis as it relates to metal price data, throw it in the chat. We'll go ahead and answer that live. And now I'm going to dive a little more deeply into, we went and just did some homework and just played around in the database to see what correlates with what. And what we're going to do is try to bring some specific cost savings ideas to you as a result of just looking through the different correlations. So I'm going to start here and just talk about, this is sort of I think there's a very commonly held belief that scrap prices and hot rolled coil prices have a high correlation. And they do. That's what I'm here to say. They do. The different prices I have here are the CME hot rolled coil futures contract. We track both a futures price, which is what we call the spot price, and then a 3-month futures price. And then we have what we call our metal miner index price, which is what we track on a weekly basis ourselves from multiple sources. And what you can see here is that all of these metals have a decent correlation with one another. So that stereotype that you might have is indeed true. Just a couple comments, though, that I want to just level set when we talk about correlation analysis. In our book, and Daniel, tell me if you disagree, but we use 85% or higher as what we would call a strong correlation. And that's why you see these little, degradations of green color. So this one at 81%, a little bit, lesser correlation, little weaker link. So I just wanted to state that. And when you see red in our slides coming up, and you will see a few, that means there's literally no correlation. Daniel, did I characterize that correctly?
Yep, I think you did. And then I would also point out that a negative correlation, which I think you'll see in a couple of the future slides, is also very important. I mean, if something correlates inversely with another commodity or a price, that's just as important as a strong positive correlation.
Perfect. Great. I appreciate that. So Don, I want to engage you here, and you let me know if you think we should talk about it on the next slide when I talk about plate and scrap. But, knowing these correlations, does it make a difference to you? And I'm going to switch to the plate one real quick. I just want to point out, so Don, I'm going to hold off having you talk I'm going to just present these two. This is a stereotype that I think people have absolutely wrong. In fact, I spoke at a recent Bank of America event and polled the audience about which form of scrap correlates best with carbon steel plate. And what we learned was that most people think that number one, heavy melt correlates more strongly than prompt industrial comp, but that's not really what the data is showing. I also wanted to show two different timelines so that you are aware that correlation, so commonly held beliefs that we have change over time. And you can see some differences between the short and the long term. So Don, let me weave you in here as you look at this. And I know as a former steel buyer of plate at John Deere, what are your thoughts when you look at this data? What comes to mind to you?
Well, you have a lot there. I'll start with this and then back to the prompt in hot rolled coil. On this, I was surprised. I would have been in your group that incorrectly raised my hand and said heavy melt. That's what most people assume tracks the plate. They use a lot of that scrap in actually making plate. You're going to contract on scrap at a plate mill. You're going to contract to that. And I think that's probably the most interesting part. So, you can do scrap contracts and things like that. And you're always, when you do that, you're tying your indexing mechanism to scrap. So if you look at this on plate, if you're tying your index mechanism to heavy melt, which is typically what a plate mill will want it tied to, since that's what they're consuming, you're actually tying yourself something that doesn't correlate very well to the finished product that you're using. And that's typically not a great idea. If you look back on the hot roll coil, you said that it ties closely to prompt, which is what people usually contract on if they're going to do a scrap contract. And that is a good idea on that end, because they are kind of closely tied. So it's important to validate your assumptions, like Daniel talked about, have a hypothesis and then look at it, see if it's right, see if it's not. In this instance, a lot of people, myself included, would be wrong on that correlation assumption. So I think that's kind of what's important.
Okay, was there anything that I needed to go back on here that you wanted to comment on?
It stands to reason that the hot roll coil number and the scrap will correlate highest to our number versus a CRU number, because a CRU number is just a number. We're looking at more of a blend, so it smooths some of that out, so it will correlate more tightly. The other thing on there is futures. I think there's a lot of people that assume futures would have a fairly high correlation too. The futures market it's liquid now, but it's not super liquid, I guess, for lack of a better term. It can get pushed around a lot more than a scrap number or a coil number, some of those things. So directionally, I would say a futures number is still an indicator to look at, but it's not a super strong driver that you should really think, well, this is what the futures market is. This is what scrap is definitely going to do, because it's a weaker correlation.
Got it. Okay, I'm going to move on now. I'm going to just throw in a non-ferrous one in here, because this applies to everything, not just steel. So you know how everybody says, you know, Dr. Copper can tell us where metals markets are headed. Well, you know, I'm going to suggest that aluminum is the new physician assistant. So physician assistant, PA aluminum, can basically perform most of the same function. And I mentioned this is a key point too. Many companies, especially those in heavy machinery, et cetera, sometimes have good external metrics that drive the business. And my favorite one to talk about is Caterpillar, that has a strong correlation with what they're going to do with the copper price, for example. And it makes sense, right? Caterpillar is a mining equipment, excavator company, et cetera. So the question that I'm going to pose to all of you is, do you have an external number that correlates well with the health of your business, your demand? If you've got anything you want to share, please feel free, go ahead and throw it in the chat room. So just a shout out here to aluminum and copper, but I want to keep rolling. We've got a lot of material here. So Don, I want to weave you back in here. And the point I want to make here is that, you know, relationships can get weaker over time, just as in real relationships can get weaker over time. And you have to be checking those old assumptions. And that's the point that we kind of showed on the steel plate and the scrap price. European steel, I was really in the last, obviously I'm looking down below at this 3-year kind of look back, really sort of shocked at the lack of correlation between Europe and either China or Europe and the United States. But in the short term, U.S. steel prices in China, you know, are indeed highly correlated. And it's interesting how that relationship's gotten a lot stronger. We know a lot of companies that track the spread between European and U.S. steel prices. They do that because sometimes they're trying to make a decision. Some companies import material, so they use these spreads to sometimes, so it's not just the spread, but the direction. To try to figure out whether or not they should, you know, import or not import or change it up, et cetera. So I don't know, Don, I'm just going to throw it to you. Anything to make of this? Were you kind of shocked or surprised by the results?
Not tremendously. So the European market, like you said, people do look at it to see what the spread is. Can I import material and save some money? But the European market for carbon steel isn't a huge market. It's enough. I mean, they participate in everything, but it's not a big giant like China is. So it doesn't really surprise me that the European market isn't super correlated to the US market. China, on the other hand, the flat rolled China steel, they produce just a massive amount of it. It doesn't come here directly between tariffs and all kinds of other things. It doesn't usually come here, but it's big enough. It's kind of like water. It will find the lowest point, and they push enough of it into the rest of the world that it can influence even the domestic price. So it doesn't shock me tremendously that it is somewhat correlated to the China number. Now, correlation and actual price is two different things. It will move directionally, as you're seeing, pretty close. The price, however, will not be the same. So I don't want anyone to be confused with that.
Good point. Exactly. That's right. This is the shape of the slope of the line, not the actual underlying prices. Very important point. I think the other thing that's just sort of interesting and timely right now is the fact that the Chinese recovery post-COVID after their lockdowns has been somewhat weaker than I think many had anticipated, including us. But I think it's because a lot of the growth or the return of the economy has really been more service oriented, travel, tourism, restaurants, food, not the things that are what we call, high metal content goods and services. And it is correlating, of course, with steel prices here, which are now coming off. So
and I think that's very important to note. You're looking at the correlation between China and the US steel number. So if China is not coming back industrial wise as people thought, their steel price is going to come down. If it is correlated to the US, that's another indicator that the US price will also get softer, which we've talked about. We think it will get softer from here.
Exactly. Okay, a silly slide called Strange Bedfellows. So this is one of my favorite topics, is when two things that don't seemingly relate. And I remember somebody once I was working with on a project for Metal Miner had told me that you can predict which country is going to have the most gold medals at an Olympics based on the most highly correlated variable is land mass, which stop and think about that. Okay, whoever has the most land is going to get the most gold medals. I mean, it sounds like a crazy correlation, but that's the principle here, right? So here we have, US steel plate prices and Korean brass strip prices. And I don't have a lot of thoughts here as to why they're correlated, but the point is that you can use these kinds of relationships, particularly if they're this strong over a long period of time, for some of what I call your book of weird and obscure metals. So if you're sourcing some weirdo tool steel that there is no market mechanism for, you might find a way to basically get your spend under management a little bit more, at least from a forecasting standpoint, by being able to map that metal to another metal. Don, anything you want to add here before I move on?
Yeah, this seems really insignificant, but it's not. There's several ways that you can use this. One of the ways is if you're trying to hedge your risk, for instance, on something that doesn't have a liquid contract. I talked to somebody the other day that was looking at ammonia, I believe, and they wanted to hedge that buy, but there's no liquid contract for it, so they couldn't really hedge it. If they could find that it correlates to something that does have a liquid contract, they can use that as a proxy to hedge. So it's not so much forecasting or understanding the market, it's just a simple 1-for-1 to de-risk some of their buy. That's one of the good things that you can do with a really tight correlation like this. Sometimes it is important to understand what's going on in the background, like why are these two correlated, because then you can make some assumptions going forward. We talked about like the scrap and the coil, or Chinese and US. I think the Chinese and US correlation with steel is a good thing to understand further down the chain what's going on. We talked about the rebound or lack thereof in China. That's kind of an indicator that will push the steel prices in the US down. So that's another way to kind of understand how these things correlate.
Thank you. That's a great point. And I've got another slide later on that kind of highlights some of that as well. And it's said differently. Okay, Daniel had mentioned the inverse relationship. So again, we're talking about relationships. Don't forget that opposites also attract. And those are also really meaningful correlations. So this one here is the US dollar index and the Chinese, ETF FXI shares, which is it's a traded ETF. This is, again, above that 0.85, the closer to 1 you get, the higher the correlation, minus 90.4%. This is a strong correlation for the last 3 years. So those of you that have a lot of US dollar exposure globally and care about what the dollar is doing, maybe the China FXI shares ETF will give you, same as like that other correlation that Donna talked about with China hot rolled coil and US hot rolled coil. You could use this inversely to understand, if one goes up, the other one might go down and vice versa. I'm going to keep rolling here on some of these just so we've got a few more things to cover with the time. Okay, I'm going to admit that this has been some of the mistakes that we've made in the past. And one of them being, how are these individual I'm going to call them macroeconomic indicators related or not related. So, here's a good example of two things that, are not related. Commodities in the US dollar, not related. There's no correlation. I know we sometimes hear that metals are priced in US dollars and that correlation is going to spur metal demand. And maybe it does for some of the metals, but it definitely doesn't impact commodities in that sense. So I just thought that one was an interesting one to call out. The other ones that I think are interesting. So these are the main macroeconomic factors from an 11-year perspective that we track. And if you look at it over the long term, you'd say, why do you bother tracking them? They don't correlate to much. So we track, again, the commodity, the CRB index, that's the Thomson Reuters Refinitiv Index, WTI oil, the DB base metal fund, which includes some of the base metals. Even that doesn't correlate with any of these other, or very little or, not so great correlations. The US dollar index, and then I threw gold in there because everybody thinks gold's related to the dollar. And, I want to show everybody that, no, it's actually not. So I just want to touch on something Daniel said in the beginning of today's workshop. Data science can provide you with sort of a way to kind of question and challenge your assumptions and provide you with some of the guideposts to better understand the market. And the reason a lot of us are confused about what's happening in the marketplace at times is because we're getting a lot of mixed signals, but you're also confused because they don't relate to anything that you buy. So you may not even need to pay attention to it. Or wait a second, maybe you should pay attention to it. Look at how this changes in the 3-year analysis. And I thought this was fascinating. And this is my point about constantly challenging assumptions. And I use 3 years. I know, Don, you're a big favor of the 3-year look back analysis. I think this is really shocking to me, to be honest with you, how much this chart changes when you kind of look at the most recent 3 years. And so again, strong correlations between oil and commodity prices. That's not surprising. Strong correlation between oil and the DB base metal fund. Again, also not surprising. But a weaker correlation between the CRB index and the DB base metal fund. Now, that's one of the correlations that we hold very near and dear to our hearts. And we report out on both each month. And, even that doesn't quite meet our own standards of that 85% correlation. So I think it's pretty interesting. And I'm just gonna skip forward because I know we're gonna run out of time in just a moment here. These are some other macroeconomic indicators along with where metals play in. And at the end of the day, a lot of the metals do have no correlation with the overall macroeconomic market, but stainless steel does. 304 stainless steel is a trove of good correlation and analysis. So before we wrap, I just want to kind of give a little bit of a summary. And again, I can share this. Everyone's going to get a copy if they want a copy of this. There's a lot of different strategies that you can take advantage of. And last but not least, the Metal Miner website. So that's agmetalminer.com. Lots and lots of free resources. If any of you are interested in having a conversation with us about something you track inside your business and you want to know if there's something outside your business that it tracks to, feel free to get in touch with any one of us. Daniel, Don, and I are all on LinkedIn, and on our website, it's got contact information. So feel free to just drop a note there. And with that, I'm going to leave you back to your day. Appreciate your time and look forward to seeing you at another workshop in the near future. Thanks so much.